Hello, everybody. Welcome to our virtual open day, introducing our executive education course on Pillar 2, Fundamentals and Practice. This course will be taught by Demis Ioannou, Christos Theophilou, and Kostas Sava, the team at Taxand, and myself. I will be moderating the course, and I'll be moderating the discussion today as well. So we thought it would be a good idea to do, although this is not very frequent practice to do an open day, or at least a virtual open day, we thought it would be a very good idea to introduce this course to anyone who might be interested. We've already had registrations, and hopefully we'll have more after the end of today. So we wanted to introduce this course to everybody who has signed up. There is a lot of interest on Pillar 2, and we are, if not the only one of the very few providers offering this online. Now, our executive education course starts on the 9th of October. It will run over 7 weeks. There will be a 3-hour session every Thursday, 2 to 5 p.m. UK time. And we do have an early bird price until the 31st of August. So please sign up as soon as possible to benefit from that. We also have special discounts for Queen Mary alumni, and also for firms if more than 3 people are registering. So do take advantage of our offers. This is a very low price that we're offering it just because it's the first time running, and we're hoping it will run many, many times. And there's actually talk of Pillar 2 becoming a paper for added purposes, although this is not confirmed yet. But it's something that has become very sort of entrenched, established practice, and there is a big need to educate practitioners on it due to the complexities introduced by Pillar 2. I would like to introduce the speakers for today, Demis Ioannou and Christos Theophilou. Demis will go first. Demis, all of our instructors, they're both chartered accountants and lawyers. Demis and Christos also have an MSc from Oxford University in taxation. So I think they're in a unique place with Pillar to be able to understand Pillar 2 and teach Pillar 2. They're both all three are seasoned instructors for added courses, international taxation, transfer pricing. And we are extremely thankful to Demis, Christos, and Kostas for agreeing to teach this course for us at Queen Mary, and for doing this session, which I think you will really enjoy. It's a session on Pillar 2, not just introducing the basics. So I won't bore you with any more details. Demis will start, and then Christos will take over.
Professor, thank you very much. Very happy to be here. Hello, everyone. My name is Demis, as Professor mentioned. So what I will cover, and then my colleague Christos will take it from there. I would like giving the big picture as a person. So what we have in front of us with an easy way, so we can build after that the more technical knowledge. So what is this Pillar 2 that presidents, prime minister of different countries, they are talking about? I think simply is a new word of taxation. We will see that is the biggest change, at least from my perspective, over the 100 years. Pillar 2 rules, to start with, is just 70 pages long, the legislation, but it's accompanied with a OECD model rules similar with what the OECD treaty has. So these 70 pages are coming with a commentary in addition with examples, and this takes us to almost 1,000 pages long about regulations and about explanations and interpretation about the rules. I have to admit that although I like as well comparative tax, it is one of the most complicated rules that I ever seen. I think it's a science on its own, this specialized area, complicate specialized area, which in my mind, that means an opportunity as well for people that they want to become specialized. But let's start firstly, very, very simple with the basics, and then we dive to more complicated rules. So as lawyer, I know that each legislation that pass from the parliament has a purpose behind it. There is no any law that it would just pass for no reason. So I think to understand the legislation, we need to make one step back and think why there is this need for this Pillar 2 legislation. What was the problem that this legislation wanted to solve? And I think we all hear the BEPS 1 project, which actually started because of the economic crisis and countries they are complaining, and there were also some examples that big MNEs they were not paying the fair taxation. So a series of BEPS projects, action plan they call it, 15 actions they were introduced from the OECD to stop what they call tax avoidance, tax planning, tax evasion, different wording, but let's put it on the way that they wanted to stop profit shifting. That's why it's also the acronym BEPS, Base Erosion Profit Shifting. This was a project that started in 2015. We have seen the action plan, the 15 actions, but when this was completed, by the time it was completed, we all realized that this was not enough to stop profit shifting. We have in front of us a very small case study. I like simplified case study at the beginning, where we have the source country, and let's say is a country A, that in this country is the big business. There you have your manufacturing, you have your clients, you have big premises, thousands of employees. This is the reality. After the BEPS, nobody could stop to set up in any jurisdiction. I will call it any offshore jurisdiction, any offshore, and here offshore. Nobody could stop to have in any jurisdiction that has zero or low tax to open companies that it will provide, in this case, financing here, and in this case, IP here. So all these 15 action plans, what it was in essence in one line, it was more about showing you what it means aggressive tax planning, and also telling you that in order to continuing doing a planning, you have to have substance. So it can be seen all these BEPS 1 15 actions as like an anti-avoidant provision, but it didn't stop the people to be able to go in any country and open, like here, a finance company or an IP company. What happens if you open a financing company? If this country here has 100 profits, you could say, okay, I have financing company that is charging interest. I will charge interest 5 to 10%. And then, of course, I can have my IP in another country, again, with preferential tax. And this also get 20 to 30%. So eventually, this country, the base of that, it will be eroded, it will be going down. Obviously, this was not the intention of the BEPS project, but as lawyers, when you read the 15 actions, you can understand that there are rules, but they don't stop you to have a financing company or an IP company anywhere you want in the planet. So coming after the BEPS project, countries realize that there are still deficiencies in the international hierarchy where you can do profit shifting. I gave 2 examples now, but there are also other examples with digital companies that if you don't have permanent establishment, we know Article 7 telling us of the treaty, if you don't have permanent establishment, that country cannot tax you. So there were also other issues that countries felt that they were losing a lot of taxation. So we have seen the year after BEPS 1, countries to take on their own hands the tools, and they were introducing digital taxes, as we have seen, and other measures. So then the OECD said, look, we cannot have different countries implementing different rules. Let's coordinate everything and let's solve the problem. So they came with this idea, Pillar 2. Actually, it was two pillars, Pillar 1 and Pillar 2. Pillar 1 was about changing the taxing rights of countries and expanding so countries that they have customers to be able to get some taxation, but never fly that because you needed to change treaties and it was much harder. Of course, there is still ongoing discussion. And Pillar 2 was an idea that let's put some minimum taxes. And if we put minimum taxes, then we can solve the problem which I'm just showing here. Because if someone sits back and says, how can I solve the example I have here and have a minimum taxation? I think there are few things only you can do. There are limited things. Either this country here, the source country, it will deny the payments. But of course, this is hard. The other thing is that you could say to these countries, you have to input 15% taxation. But again, maybe some countries, they will say, no, I don't want to add any taxation. I am a sovereign country. I don't want that. So also to tell these countries that, add 15% was also not really the case, because is one thing to say to countries, is another thing to enforce them, and it's also another thing to show what it means 15%. Is it effective? Is it just the rate? So they came with this idea to see holistically and says, all right, let's build it together. They said, what we have is that we have a group of companies. So let's start by saying that if any country in the group, the taxation of its income is not taxed at minimum 15%, and they define what means minimum 50%, what is the tax base, what is the income of that, they define it, and they are using accounting standards. That means the parent company will get the IIR, my friends will explain it, Christos, it can get that tax, the ultimate parent entity. So they said that. Then they said, okay, how I can say and continue with that these countries here, they will be also taxed. And I think the case here is that they said that if these countries here, they don't tax, so rule number one here, this country can tax that income. So by showing these mechanisms, it made these countries here to be able to say, look, let's also add a minimum taxation in order to keep this taxation for us. Otherwise, it will be dragged to the top of the structure. So what the OECD came to say is that all the profits in the group goes to the UP. There are exceptions, but let's get the big picture. Unless the other entities, they also introduce a qualified domestic minimum top-up tax. If they do that, then the parent entity doesn't get it. So they create a mechanism where it gives incentives to countries in any place of the world to introduce these minimum taxes, because if they don't, the ultimate parent entity will get all their profits and tax them. This is how they structure it. But of course, we can start understanding that this is a big picture. There are many questions. What do you do with double taxation? What do you do with other taxes, and etc. But I think the big message is that we see a mechanism where the OECD introduce a corporate tax for big groups which run on the top of the existing system. So any country that has its own tax rules, And on the top of that, and I'll show in a minute a slide, we have these new income tax rules, which is for big groups. So they run parallel. There is also a discussion, what is Pillar 2 at the end of the day? Is it an additional corporate tax? Is it an anti-avoidance provision? Is it a coordinate minimum taxation for all the countries? I think the better view, as we are understanding, is to treat it as a separate corporate tax, which has its own rules and its own calculations, with them to have a minimum 50% effective tax rate in all the companies in the group. Let's move on from this. This is the background. As lawyers, the first thing that we need to identify and have in our table, in our desk in front of us, is the sources of law. Lawyers, we don't say anything unless we read the law and the law provides for it. So when now we are advising a client, or when a client has an issue, in my desk, I have different sources of law. Domestic tax law, I have the double tax treaties, I have the EU tax law, and I have now also the Pillar 2. So in order to be able to calculate correct the taxation for an LTD, I have all these different sources in my desk. The follow-up question is, okay, but these different sources, how do they interact? Is it any hierarchy? Is it just separate sources? What if they contradict? Which prevails? This is a critical things that we need to be able to clear from the beginning. So how this works? This works as follows. Each country, you start as you start before the Pillar 2. You find the domestic law, then you apply the treaties, and then you have a taxation that you have to pay in a country. Then you now putting on your other glasses of Pillar 2, you ignore what you have calculated, and you are coming like a policeman to do a new recalculation, a completely new recalculation in order to identify the minimum tax. In order to make a complete new calculation for Pillar 2 purposes, this Pillar 2 law has to give us something. It has to tell us what is a person, otherwise you cannot tax it, what is resident, what is income, what is expenses, and etc. So Pillar 2 come as a policeman to check and to calculate on its own the computation for the entity. So that's how it works. And if what you have done here as step number 1 is below 15%, then here there is a top-up tax. I just explained, I don't want to comment again, otherwise I confuse people, how it works that first go to the IIR, to the parent, and if the other entity has a qualifying domestic minimum top-up tax, then it gets priority, and therefore it doesn't tax at the top level. These are complex rules, but let's keep it simple. So again, here, the sub is making the calculation, and the parent, again, is making the same calculation as I just explained. So the parent has to do his domestic law and the treaty, and then a policeman will come and will tell the parent to make a recalculation. Here, the recalculation is about as well finding whether the parent entity can take any income from the subsidiaries for the reason explained. That's how they interrelate all this, and it's very important in the law to know the hierarchy of the sources, the hierarchy, and the interplay. Otherwise, we will not be able to give an advice and we'll get confused. Moving on. As I said, Pillar 2 is a corporate income tax. So it's an income tax that applies to entities. It doesn't apply to individuals. And entities, big entities, my colleague will cover that. There are threshold, 750 million, and etc. So the first question when you are meeting for first time a corporate income tax law is to again ask, what does it tax? What does it tax? When we say what does it tax, we mean the tax base, we mean the income. And historically, countries didn't agree. So different countries, they have different corporate tax rules, but they didn't agree what they should tax. So we have these three concepts. Some countries, like the US, is telling you mostly, because there are also exceptions, whatever you received is income. They call it accretion. Whatever you receive and your wealth went up is income. Then we have the source concept, which is something used in the UK, but also in Germany and in other European entities, is telling you, no. Income is not something, everything, is something specific. So for example, if you win the lottery, it's not an income. For these countries that they have the source concept, they said that income is something that has a source. If you have a source and they tell you what is the source is the business, can be the employment, can be the dividends. So it's giving you some definitions, what is a source concept in order to identify the income. And then there is the trust concept developed in the UK, which again is telling you, yes, I am a source country, but each time I sell a capital transaction, I don't tax you on that. I don't see as an income. I see as a capital transaction. So the question is, what Pillar 2 is about? What type of income? And the idea is that Pillar 2 is an accounting concept. So it using the income as defined by accountants. I am a UK chartered accountant. I remember in my previous life that accountants have their own rules. What is income? What is unrealized? What is realized? So to find what is income for Pillar 2, the rules are accounting. So you get your financial statements, that's your income from there. And I think there is a reason why Pillar 2 decided that, because they believe that, and they're right, you need to have a homogeneous, the same income calculation in all the countries. Otherwise, there will be either double taxation or avoidance the whole taxation, because they will not, the incomes, they will not be the same. So if one entity has different way of finding the income and other have different, they can be mismatches. So they said, I will use IFRS and other acceptable standards for each entity to calculate the income. All right, so as I said, Pillar 2 is a corporate, let's put it differently, it's an advanced corporate income tax law. Any income tax law, either is for corporations or for individuals, because some countries, they have one income tax law and applies to both, to entities and to individuals. Some others, they have income tax and corporation tax. Doesn't matter. The title is income tax. Either it applies to corporate or to individual. So any corporate tax, any corporate income tax has to give us these answers. If you open any tax law in the world, it has to tell us this. Why it has to tell us this? Because income taxes, it taxes the person. So the first thing, they have to tell us who is taxed. Who are we taxing? Which entities? All the entities, what do we do with partnership? What do we do with trust? What do we do with other entities that they can be like the US company that you can check the box? And here, the idea again here, they are using the same ideas with accounting with different as well rules. What are you taxed? Again, we said about the accounting. When are you taxed? timing. You have to tell us, when do you account for the income? Here is again accounting. How much is the income? Here they use transfer pricing rules. Then, of course, we move to the jurisdiction issues. When we have a cross-border transaction in the law, we have different rules. We call it different jurisdictions or different countries that they want to tax the same income. They have to as well give us the answer. Do they tax based on residency, on source? How do they do that? And of course, the process as well. How do you add expenses, losses, and etc.? All these here are in all corporate taxes. And of course, in Pillar 2. Most of the idea is that let's use accounting. Of course, easy to say, but very difficult to do it because there are also very many exceptions as well. So that was my idea, and I will give it back to Professor. Big picture view, Pillar 2 is an advanced corporate tax law, and the way structured, if you have a source country and then you have payments to any low tax jurisdiction, the first rule is that everything goes up unless these low tax jurisdictions have implemented a minimum taxes. Professor, thank you very much.
Thank you very much, Demis. I think you raised some very interesting points about the differences between the traditional tax systems with the Pillar 2 and the theoretical underpinnings. There's quite a lot of debate on Pillar 2, especially in the EU, which adopted it more or less as a directive. So very interesting discussions there as to the differences between the traditional tax system. And in fact, let me just, before I pass on the baton to Christos, let me just say that next week on the 23rd of July, we have an online seminar dealing with the extraterritoriality aspects of the UTPR Pillar 2 rules, digital services taxes, and the US tax countermeasures. So Demis, Christos, Kostas will be speaking, and we will have a discussion of research done by Professor Ruben Avillona and Professor Blanchet. I can't spell his surname. We've advertised this on LinkedIn. It's on the 23rd of July. I think it's 3 UK time because we wanted to capture the US audience. But this is it's just basically taking on from what Demis said about the issues arising with Pillar 2. One such issue is the UTPR and extraterritoriality. And you can see this discussion also from a technical perspective, but also from an academic perspective by leading Professor Ruben. Okay, let me pass on the baton to Christos. Christos is also an old friend. I've known Christos for many years. And I have to say, every couple of years that I saw him again, he will be doing a different degree at a different university. So he's become, at the same time, he's a chartered accountant, he's a lawyer, he has an MSc from Oxford, and I think now he's doing a PhD. So thank you, Christos, for taking the time to do this for us and generally for helping me set this course up.
Thank you, Professor Christiana. Thank you, everybody, for joining us. My name is Christos Siophilou. I am of the partners of Taxand, STI Taxand. And now we are going to dive into the 6-step approach of how we actually calculate the top-up taxes. And let me take you to step by step of how we actually apply this in our practice. So the first step here is to consider whether you are in scope. Any person, you have your personal scope, as Demis explained, and if you are in scope and you get the green light, it means that you move on to the second step. And the second step is to identify which entities are in scope, because maybe you are a big group and you have, I don't know, 100 location of companies, but not all of them should be scope. We need to identify where you are in scope, in the location where you are in scope. The reason is because the rules, unlike the GILTI of the US, which is on a global basis, the global blending, the rules here apply on a jurisdictional basis. So we need to separate the entities and the locations. We are going to see, for example, that maybe you are organized in the BVI and you are tax resident, for example, in Germany, then it means that the company will be included in the German tax computation and not in the BVI when you are organized. And when you are identify where you are in scope, you need to calculate the tax base, which is the denominator of our calculation. And then you move on to calculate the tax rate, which is effectively your taxes, which is the numerator of our equation. And at the end of the day, if we ended up to be more or less than 15%, then we go and we calculate the top-up tax. And if there is any top-up tax, the final step is to allocate the top-up tax to the jurisdiction where the ordering rule applies. So this is a big picture. And let's dive into step by step how this applies in practice. So step one is to determine whether you are in scope or not. And here, to determine whether you are in scope, as we have seen earlier by Demis, there is a very wide definition what entities are in scope and also permanent establishment as well. And the rules, they also apply to large-scale domestic group. So the rules apply to cross-border groups, but for the EU purposes, or even jurisdiction wants to apply this for domestic groups, it also applies to domestic groups as well. The rules, of course, applies to groups that they have consolidated revenues more than 750 millions. This is a threshold test on a 4-year test. There is a look-back period of 4 years to see if you are applied or not. And just let me point out here at this point that the threshold and the rules and the definitions, the OECD use the country-by-country reporting. So if you are in scope for country-by-country reporting, you will normally need to test whether you are in scope for the Pillar 2 rules as well. The one big deviation is the look-back period of the 4 years that applies to Pillar 2. And then the next step, the next sub-step of step one is to exclude entities, because there are entities that are actually excluded from Pillar 2 rules, like certain not-for-profit organizations and some other entities. So these are the steps that we typically follow under step one. Now, what you also need to consider in practice is that entities might be member of the group, but maybe they are not included in the consolidation. So you need to identify also any entities that might be excluded from consolidation. And also you need to take into consolidation the accounts of the consolidation. But if, for example, you might not have, for example, account that is a deemed consolidation test. So it's very, very important to identify your entities. And the definition of entities, as we look at, it means any legal person, and typically this is wider in scope than domestic tax laws of countries. And it doesn't include, of course, individuals. It doesn't include natural persons, but it also includes and picks up any arrangement that prepares financial accounts, such as partnership or trust. So you'll notice here that the Pillar 2 rules, they pick up entities that they will normally not be picked up in a domestic tax legislation. For example, the term partnerships in common law jurisdictions usually are treated fiscally transparent, and they do prepare financial statements. Normally, under that law, it will be an entity in scope for Pillar 2 rules. Same as trust. Trusts are typically treated as fiscally transparent, but for Pillar 2 purposes, they might be included in the definition of entity. Now, as I mentioned earlier, the sub-step one includes a 4-year look-back period. And for example, if your tested year is the 2024, you need to look 4 years back. And just to note something here is that we're going to see this in practice. The test is not cumulative, so it doesn't have to be, it's a cumulative test, but not on a sequential basis. So if, for example, you're above the 750 millions in 2021, and also 2023, then it's 2 out of 4 years you are in scope, and for the tax year 2024, the rules apply to you. And of course, if let's say, for example, your tested year is 2025, then you need to look at 2023, 2022, 2024, and 2021. So every year you need to make your test and see whether in that year you are in scope or not. Of course, there is a list, and we're going to see them, of course, this in practice. There is a list of entities that are excluded, so you don't need to include them in your test and in your calculations. And these excluded entities are separated. We separate them in 3 categories. Is public interest entities, some investment vehicles that are typically tax neutral, and also some other holding and control entities, typically real estate investment funds and investment vehicles. They are typically excluded. Now, as I mentioned earlier, it is important to know that for the excluded entities, you don't exclude them for the group test, whether you are in scope, but you exclude them afterwards. And also there is a deemed consolidation test. We're going to see this in practice. Maybe the group doesn't prepare consolidation. It doesn't really mean anything. You still need to do your consolidation, and you still need to do this test to see whether you are in scope or not. Of course, the OECD includes some rules for multi-party groups, for dual listed arrangements, stable structures. We're going to see them, of course, this in practice, complicated rules, but still, these are the rules there. And of course, we will not forget merger and demerger rules that they might apply in practice, because you might leave or enter in the group and your consolidation test might change, your revenues might change, and you need to look at whether you are in scope or not. All these, of course, we are covering them in our session.
Christos, there is a question: if a company is owned 50-50 by 2 parents in 2 different jurisdictions?
Yes.
That's the question. Maybe, I don't know whether you're addressing this later on.
What if a company is owned 50-50 by 2 parents in 2 jurisdictions? That's a very nice question. So the control test here, you need to see whether you are included in the consolidation. So this is IFRS 10. Typically, if you are 50-50, you need to see who controls that entity, because maybe control for IFRS, it doesn't really mean more than 50 or less than 50. You need to have control, and probably, and in practice, it's difficult for 2 groups to control the same entity. So you need to see which group controls that entity, and in which IFRS and which consolidations that entity is included as a line by line. If you are included as a line by line, for example, in Group A, then you count that entity in Group A. If Group B includes that entity on a line by line, then you need to account that entity in Group B. I hope I answered your question, but let me know if you want, if this is sufficient for you. Now, when we identify, of course, all entities that they're in scope, and one of the ways is to see whether you are 50-50 within the group, then you need to allocate the income of those constituent entities on a jurisdictional basis. So you need to identify all the entities, all your PEs, all your arrangements, and you need to account this on a net income basis. And also you need to determine their location. Very, very important to determine their location, because their location is there where you are going to effectively allocate your income. For example, as I mentioned earlier, maybe you are organized and legally in BVI, but you are tax resident elsewhere. Your income will be allocated to the jurisdiction where you're tax resident, and not in the jurisdiction where you are effectively incorporated. And of course, there are also, and we're going to see this in practice, dual resident rules that follows tax treaties to see whether you are resident if you are a dual resident entity. And there are also rules for stateless entities as well. And as soon as you determine the allocation, you need to allocate your income, your financial income, And of course, if you have a PE, we need to also do the rules of the attribution of profits of Article 7. And also we need to adjust the income for fiscally transparent entities. So if you have transparent entities, maybe you have a partnership or a trust, it's not a constituent entity, but it's fiscally transparent in any jurisdiction, or you have a hybrid vehicle, then you need to find how you are going to allocate the income of that fiscally transparent entity. And once you do that, so you have your map, you have footprint on 15 jurisdictions, you allocate the entities in 15 jurisdictions, you allocate the financials on those 15 jurisdictions, then the next step is effectively to calculate your tax base, your global income. And here, the OECD provides 3 different types of adjustments that you need to align your tax base. And these are adjustments that they're actually agreed by 150 countries, more than 150 countries of the inclusive framework. And all these adjustments here, we provided you in our slides. All these adjustments in Articles 3.2, they are found in Articles 3.2 and 3.3 of the OECD model. We have effectively separate them into different categories, whether they're required, whether they're elective or not. And you can see that all these adjustments, these are the only adjustments, by the way, that you need to do. There is nothing else. These are the only adjustments that you need to do in order to end up to your tax base. And then after you calculate your tax base, then you need to dive in to calculate your taxes covered. And to calculate your taxes covered, again, there is a 4-step process of doing that. First, you need to see whether this is covered taxes. There is a definition within the model rules, what is a covered tax and what is not. So there is a positive definition and a negative definition at the same time. What is a tax and what is not a tax? And then, of course, there is a mechanism to adjust temporary difference. As we've seen earlier, the tax base is adjusted for permanent difference, whereas any temporal difference are thus based on the deferred tax rules of IFRS. These are temporary difference that the inclusive framework agreed that all temporary difference should be accounted based on IFRS. And after you finish your temporary difference, you need to account any cross-border allocation of taxes, like withholding taxes, CFC rules, and the like. All of these rules, they need to be allocated to the jurisdiction that these taxes are actually suffered in order to avoid double taxation. And finally, if there are any post-filing adjustments, any errors, any mistakes, or any tax audits, you also need to account these in your computation of your taxes covered. And this is a formula, what we discussed until now when you do your calculations. Effectively, this is the previous step. This is step 4 that we've seen earlier, and this is step 3. And when you do this in each jurisdiction, assume, for example, that in step 4, the result was 100, and in step 3, the result was, let me use more plain numbers, it was 100. So this means that your effective tax rate is 10%, lower than 15%, and this means that you move down to calculate your jurisdictional excess profit and your top-up tax. But if, for example, here, your calculation ends up, and this is what we are going to see, of course, many times in practice and a lot of examples, if your calculation here is 16, it means that your effective tax rate is 16%, and you stop here, you don't need to do anything else. So this is what chapter effectively 5 says in the OECD model rules, and this is step 5, how you effectively calculate your top-up tax. And if there is any top-up tax, let's say there is a top-up tax of 10 millions, the key question there is how you allocate these 10 millions between we all see these big Christmas tree structures when we see them in practice, and we need to see, okay, there is 150 companies in this Christmas structure, who gets the money. So who gets the 10 millions? And there is an ordering rule that applies in the Pillar 2 rules. The first one that gets the money is the low tax jurisdiction, in case that low tax jurisdiction applies the qualified domestic minimum total tax. So if the country applies a qualified domestic minimum total tax, this means that these 10 millions of this constituent entity here will be picked up in that jurisdiction. If, and then we move on to the second ordering rule, if, for example, the low tax jurisdiction here does not apply the qualified domestic minimum total tax, there is no domestic law for this, it doesn't provide that, then the IIR, the so-called income inclusion rule, which is similar to GILTI, like a super CFC rule, this jurisdiction will effectively take the 10 million. And in case that the low tax jurisdiction does not apply the qualified domestic minimum total tax, the UP state does not apply the IIR, there is no IIR here, it's IIR-free this jurisdiction, then it means that all the intermediary parent entities all the way down, they are eligible to pick up the 10 millions. And if at the end of the day, and this is the big discussion that we have right now with the US, if no jurisdiction applies either the qualified domestic total tax, the IIR, or the intermediary parent entities, then any entity within the group that applies the UTPR can pick up the 10 millions, irrespective of where you are located. If you are part of the group and you are applying the UTPR, like the EU jurisdictions, it means that you will pick up the top-up tax amount, which is the 10 millions. Now, this is what we are effectively explaining in practice in our session, everything from the beginning to an end. And also, let's dive in a bit of how this is applied in practice. This is the general income and capital structure. I mean, the income is split into active and passive, or investment and business. And of course, the passive is split to dividends, interest, royalties, and rental income. And let's see how Pillar 2 effectively, how we have seen this, the Pillar 2 effectively applied in practice. Now, the good news comes from holding companies. These are the typical structures that we see in practice and we are using in practice. Holding companies, as per Article 3, 2.1 B and C, under certain circumstances, dividend income and capital gains tax is excluded from the tax base, and therefore the holding companies are kind of not picked up when it comes to Pillar 2. So the good news, holding companies are outside the Pillar 2 rules. Of course, as we have seen earlier with Demis, the branch structure that we have seen in practice is kind of amended because the PE rules apply differently in the Pillar 2 environment. As we know, what is the current status of the PE? For example, if you have a company resident in state R, and this company has a PE in state S, so this is a PE, and the PE has profits of 100, and the head office here has profits of 200. As we know until today, how the PE rules is that the head office will tax 300, all the profits that go up. However, in the Pillar 2 environment, the PE is kind of elevated to an entity, and the profits of the 100, they don't go up, they stay at the PE jurisdiction, and therefore the resident jurisdiction, the head office here, will tax only the 200 and not the 300. So the PE structures in a Pillar 2 environment, they actually don't work in the same way, but they work differently. Now, if we move on to finance companies are actually taxed in the normal way as we know until today. There are actually no specific rules for financing companies, but there is a kind of anti-hybrid rule at the avoidance provision under Article 3.2.7. And of course, there is a transfer pricing rule under 3.2.3, which effectively, good news for those that are working on transfer pricing. Transfer pricing is actually respected by Pillar 2 and it doesn't effectively affect a lot transfer pricing. Of course, there are special rules there, but Pillar 2 respects transfer pricing, and transfer pricing will continue to exist in a Pillar 2 environment. Again, the branch structure, it works differently in a Pillar 2 environment because the profits of the branch structure, they don't go up to the head office in the Pillar 2 environment. Now, this is the supply chain. This is what trading of goods and services that we see in practice. There is no specific rule or adjustment in this supply chain. So effectively, in the Pillar 2 environment, these kind of structures, this is what they're actually trying to attack in the Pillar 2, and they're trying to get the top-up tax where the M&E effectively has transferred to the principal entity all the profits in the low-tax jurisdiction. This is effectively what the Pillar 2 is trying to achieve. And of course, we also going to see some incentives. Again, these are the IP box structures that we see in practice. These IP structures, they are highly affected in a Pillar 2 environment. Any incentives, especially in the exploitation phase, like the IP box, they are washed out under the Pillar 2. However, in the development phase, there are certain incentives that the Pillar 2, they're kind of bulletproof, not just for, I would say, IP structures, but in general. And there is a very good report, and we also need to look at the incentives in practice from the OECD perspective that says that which incentives actually in the tax policy of the country, they are encouraged by the OECD, and these are expenditure-based tax incentives, whereas you are going to see that the Pillar 2 rules, they will wash out any benefit mostly provided by income-based tax incentives. So we are expecting from a tax policy perspective that countries, in order to adapt in the Pillar 2 environment, to provide more expenditure-based tax incentives rather than income-based tax incentives. And this is the formula that we discussed right now. A very important point to note is that if the top-up tax is below the 15%, then effectively you don't need to, this is the only case that you calculate your jurisdictional excess profits, the so-called carve-out. So if you are a high tax jurisdiction, you don't get your carve-out, you don't get your jurisdictional excess profit. So effectively, from a policy perspective here, the Pillar 2 says that if you're a high tax jurisdiction, you are wasting your carve-out. If you're a low tax jurisdiction, you are utilizing your carve-out. So we also going to see in practice that low tax jurisdictions, they will be effectively using their carve-out, which is effectively based on two components. And the two components here is payroll and assets. And when I say assets, I mean tangible assets, because intangible assets, they are excluded from the carve-out. So we are going to touch upon how countries they are effectively using their tax incentives and what tax policymakers can effectively do in practice when it comes to Pillar 2. Now, we also seen in practice that the Pillar 2 is actually not the economic substance issue. So we discussed a lot of times that the BEPS project is here to tax the profits where value is created, where is economic substance, and so on. Actually, the Pillar 2 rules does not follow that direction. It's just a calculation game where your calculation are and whether you paid more tax or low or more, and then you pay the difference. So we see that the Pillar 2 might not solve the actual problem or does solve the actual problem, but we're going to see this in practice as well. And finally, we are also going to explore some strategies that we have seen in practice by multinationals. A lot of multinationals, they effectively might not do anything. They just pay their taxes. This is something that we've seen in practice. They might not want to change their business model or their locations. And this is a strategy. Do nothing is a strategy. We've seen this in practice, but there are some planning here because you might fall under the de minimis exception. And effectively, if you are in a low tax jurisdiction and you meet the de minimis rule, you don't pay an extra tax there. There is also the planning arrangements. There you want to locate your activities in a low tax jurisdiction and pay the 15%. So you don't want to move. You need to pay your 15% because any alternative option, and we see in practice, let's say you are in a low tax jurisdiction and your next best option is to move to a high tax jurisdiction. Why would you move there since the difference still is higher if, for example, your best alternative here is 20%? Now, there is also some planning element that we've seen in practice to combine on a jurisdictional basis high tax profits, blend them with low tax profits. And at the end of the day, if you blend the high and the low tax profits, you ended up to be in a high tax rate. And effectively, those low tax profits are flying free outside the Pillar 2 rules. But this should be on a jurisdictional basis. It's not like the GILTI, which is a worldwide basis. Now, another strategy is we've seen this in practice, multinationals might want to move to a low tax jurisdiction. Let's say in that jurisdiction has an effective tax rate, let's say 13%, and that jurisdiction provides a generous qualified refundable tax credits or a substance-based income exclusion that will effectively artificially increase your effective tax rate or lower your tax base, and therefore your impact will not be that high. Or to move your jurisdiction, this is the fifth strategy, or to move to a jurisdiction that offers this generous high tax rate. And a final strategy that we have seen in practice is that, and this is acceptable by the OECD as well, is that if you are above the 15%, you still, the Pillar 2 rules don't apply to you. And since the Pillar 2 rules don't apply to you, you can move, you can do profit shifting. Let's say if you are in a high tax jurisdiction of 20%, you can still do the profit shifting from this 20% to a lower effective tax rate, which is 16%. In both these jurisdictions, the Pillar 2 rules will not apply. So this is the end of our presentation. Hope you enjoyed our presentation and what we will be covering in our session. Of course, we have some reference here. We are going to circulate the slides if you want to download the OECD rules and all the commentaries, examples, and so on from the website of the OECD. And also we have some further reading for you if you want to read more articles. We also recommend a specific book that we also co-author in that book, and this will be a recommended reading in our session as well. And if you have any questions, feel free to make your questions. We're here to make discussions and explain more about the Pillar 2 rules, the course, and any questions that you might have. Professor Christiana, back to you.
Yes, Christos, thank you very much. We do have a few questions. One, Rolanda's asked a question about globe losses, and if they can be carried forward if there's no top-up tax. And we also have a question by Conrad, who, if I'm not mistaken, he's joining LLM program in September, and he has shown me interest on the Pillar 2 rules. Yes, I'll let you. They're on the chat. I think question and answer. No, they're on the question and answer box. Christos.
Yes, I mean, anyone who has, maybe me or Demis can pop in and answer the questions.
Yes, anybody.
Yeah, so globe losses, the globe losses, actually, we don't have these carry forward rules that we typically have, for example, or carry back in that we see now in practice. But what it is included in the Pillar 2 for losses, there is a special rules for a tax consolidation scheme. which is in Chapter 3, which is the tax base. And there is also the losses are included in the deferred tax part in the calculation of the effective tax rate. So the losses that will kind of carry forward based on the Chapter 4 of the model rules, the OECD model rules, which is effectively the calculation of your taxes covered, which is the numerator of the formula. Demi, feel free to pop in any time on these questions.
Yeah, I think Christos, you're right. It's just there is no brought forward losses as we know, and I think the number there is coming, or the trick is with the deferred tax asset. So since the IFRS they have this computation about deferred tax, including some rules in Pillar 2. And how that works is that the taxes that you pay is reducing is adding up to find the effective tax rate. There is an additional element, which is the deferred taxes. So what it's trying to do is that if you have brought forward losses, that they will come in at the year where you have your deferred tax asset, and it will increase your taxes that you paid effectively in your jurisdiction. So by doing these mechanisms, they, in a way, of course, I'm not sure if they do it fully, the numbers show us differently, they incorporate the brought forward losses to the deferred tax.
Yeah. And also, just to add another point on this in the of Rolanda question, is that there are also some transition rules for first year that you enter into Pillar 2 rules. So there you need to take into consideration tax attributes that are coming in because in the previous year you were not in the Pillar 2 environment. So there you also need to take into consideration the any brought forward losses that you might have before you enter into a Pillar 2 environment when you are outside the scope. There is a question on safe harbor rules. Of course, we are going to cover the safe harbor rules as well. We might not dive into the details about the safe harbors, but the answer is yes, we are going to cover the safe harbor rules. And there is also a question by Conrad, do you envisage that the country by country safe harbors will be extended? This is an excellent question. I think that Conrad is raising this with the discussion that we are currently have with the US, that we might extend it to US multinationals, how this will work in practice. We are expecting that something will happen for sure with the US. There should be an agreement with the US, and the time is ticking up because they need to submit their tax returns. They have already provided a provision in their financials, so there should be an agreement of what will be the impact of the US multinationals. Of course, the US is not expected to accept Pillar 2. The US in its international tax history has never signed, at least to my memory and to my mind, any multilateral instrument like the MLI, the country by country, the exchange information of the exchange information of country by country reportings. So like CRS, they have their own system like FATCA. So we are expecting that the Pillar 2 and Pillar 1, of course, will be running side by side, that anything that the OECD agrees with the US, it will be difficult to predict how the agreement will be. I mean, even the G7, they met earlier this month and they couldn't come to an agreement. So this is something that is taken care by the OECD and the EU right now. Of course, there is an agreement there, but in order to be an agreement, it needs to be agreed by the inclusive framework. So this is something that we are expecting to come in the next coming months. And I believe that there will be an agreement and there should be something extra in the safe harbors. I presume yes, but we don't know what will be this outcome. Maybe we discuss this also as well next week with Professor Aviona from the US. Maybe Professor Aviona might shed more light on what's in the US minds for the Pillar 2 rules.
Yes, thank you very much for reminding me about the event. As I said, you connect with it. By the way, connect with us on LinkedIn if you haven't already, so you can see the announcements we make about the course events surrounding Pillar 2, our Pillar 2 course education provision. Just to say that also this has been recorded, and I've been told it will be made available on YouTube, and we will notify everybody who's registered, or if you haven't heard from us in about a week's time, get in touch with us. But the idea is to put this recording, make this recording available. Also for students who sign up, there will be, so there is a book that Christos was one of the contributors, which I actually have here, and we Pillar 2 of the Inclusive Framework on BEPS. It will be one of the suggested readings, and it will be heavily discounted for our students. We will give out a discount code for those who would like to buy it, although it's a suggested test, is not a prerequisite. So just sort of some tidying up for this. Let me just see. I think we have more questions.
Actually, Christina, the next question will be answered in the following week. So our webinar,
yes,
the UTPR is extraterritorial or discriminatory. So excellent question. It will be great. We don't have time right now. We are a bit late.
Yes,
but we are going to discuss it next week.
Yes, this as I said, we're going to have this. I will try to share my LinkedIn, or if you go on my LinkedIn page, you will see the event that we have. Let me just put on chat that we have just remarketed. Yes, this is an event with Professor Ravione, and it's based on his paper and one of his collaborators. And what issues that will be discussed include extraterritoriality of the UTPR and digital services tax, because now that's a big issue in the US with the side agreement. Now they're more focused on digital services tax and whether they will be triggering their Section 891. So please come back. Please register for this event. Let me just put this on the chat. I don't know how to open a new question. Do you know how to share a link on chat? Let me just type the answer for the last question, where I've shared the LinkedIn post, but it's on the 23rd of July. Go and Google, go and look at the LinkedIn announcement of this event, and that will take this sort of a step higher when we talk about extraterritoriality and all the controversial issues with Pillar 2, more or less. And of course, to delve in more detail, sign up to our course, which starts in October, and you will have, which is 21 hours of teaching. We're going to detail in a lot of these topics. And by then, there may be more developments from the US perspective, the EU perspective. Okay, thank you very much. Thank you to Christos. Thank you to Demis for this very interesting presentation. Thank you to everybody who signed up to our open day. I hope we managed to convince you about our course, and do sign up as soon as you can to benefit from the early bird price. And I hope to see you in October. Thank you very much.
Thank you, Professor.
Thank you very much.
Thank you.
See you at the course.
Thank you.
Bye.
Bye-bye.